You just paid all your bills. You look at your bank account and somehow, miraculously, there's an extra $1,000 just sitting there, not earmarked for anything, not promised to the electric company, not silently judging you from the savings column. Just $1,000. Vibing. So now you've got a decision to make. Do you throw that money at your mortgage like you're trying to knock out a heavyweight champion, or do you toss it into your retirement account and let compound interest do its slow, magical, kind of boring thing for the next 25 years? I'm Maddie, and today we are settling one of the oldest debates in retirement personal finance. Should you pay off your mortgage early, or should you invest that extra money for retirement? And before you scroll down to the comments to tell me, Maddie, it depends. Yes, I know. It depends. But by the end of the next 12 minutes, you're going to know exactly what it depends on, and you're going to walk away with a real plan instead of that vague financial anxiety we all carry around like a second wallet. Let's get into it. Okay, so to make this whole thing not feel like a textbook, let's use a real example. Meet Dave and Sarah. They're 40 years old. Here's their situation. They've got a $300,000 mortgage. Their interest rate is 3.5%, which by today's standards is basically a financial cheat code. They've got 25 years left on the loan, and after all their bills, groceries, the kids' soccer, Sarah's oat milk addiction, and Dave's mysterious Amazon packages that show up every Thursday, they've got an extra $1,000 a month. $1,000 every month, just looking for a home. Now, if they invested that money in the stock market, history says they could probably expect somewhere around an 8% average annual return. Their mortgage cost them 3.5%. So on paper, and I cannot stress this enough, on paper, the math screams, invest, you beautiful souls. But personal finance isn't done on paper. It's done in real life, and real life has things like stress, sleep, marriages, layoffs, and that weird feeling you get at 2 a.m. when you remember you owe the bank $300,000. So let's actually break down both sides. Honestly, no cheerleading. Let's start with paying off the mortgage early. And listen, I know in the YouTube finance world, paying off your mortgage early is treated like the dorky cousin of investing. Like, oh, you're paying off a 3.5% loan. Cute. Anyway, here's a guy in a Lamborghini telling you about index funds. But hold on, there are actually some really powerful reasons to crush that mortgage early. Reason number one, and this is the big one, every extra dollar you throw at your mortgage gives you a return equal to your interest rate. Tax-free in a sense, no volatility, no oops, the market dropped 20% because somebody tweeted, just a clean 3.5% or 6%, or whatever your rate is. That's not nothing. Reason number two, lower retirement expenses. This one is sneaky huge. Imagine waking up in retirement and your housing cost is basically just property tax, insurance, and the occasional why is the dishwasher making that noise moment. No mortgage. None. That can drop your required retirement income by $20,000 to $30,000 a year. You don't just need less money to retire, you need way less money to retire. It's like trying to fill up a swimming pool and trying to fill up a bathtub. Same hose, way smaller goal. Reason number three, peace of mind. And I know this is the squishy reason. This is the one that doesn't go in a spreadsheet. But you know what? Spreadsheets don't lie awake at night. People do. There's a very specific kind of calm that comes from owning your home outright. No bank can take it. No job loss can take it. You could literally lose your income for 2 years and still have a roof over your head. That kind of security, for some people, is worth more than chasing an extra few percentage points in the market. Okay, now let's flip the script. Let's talk about investing for retirement, which, fair warning, is the side I lean toward for most people. But I'll tell you why, and I'll tell you when it falls apart.
The first and most obvious argument, higher potential returns. Over the long term, the stock market has averaged somewhere between 7 and 10% per year, depending on how you measure and which years you cherry pick. Let's just call it 8 to keep things simple. If your mortgage is 3.5% and the market gives you 8, you are leaving money on the table by prepaying the mortgage. That's not opinion, that's math. The gap between what you owe and what you could earn is real, and over 25 years, that gap turns into a number that will make you do a little gasp. Which brings me to argument number 2. Compound interest, or as I like to call it, the most powerful force in finance. When you invest $1 at age 40, that dollar isn't just earning interest, it's earning interest on interest on interest. By the time Dave and Sarah are 65, that $1,000 a month invested at 8% has grown to roughly $950,000, almost $1 million from $1,000 a month. That's not me being a YouTube guy. That's a calculator and 25 years. Meanwhile, if they use that same $1,000 a month to pay off the mortgage early, they'd save somewhere around $150,000 in interest and own the home maybe 12 to 15 years sooner, which is great, but it's not $950,000 great. Argument number 3, tax advantages. This is the part nobody talks about enough. When you invest in a 401k, a traditional IRA, or a Roth IRA, the government basically becomes your slightly weird business partner who pays you back in tax breaks. You're either deferring taxes or eliminating them on the growth entirely. And if your employer offers a match, listen carefully, that is like free money. If your employer matches your 401k contributions up to 5% and you're not taking it, you're literally turning down a raise. You wouldn't walk past a $100 bill on the sidewalk because you were busy paying down your mortgage. Don't walk past your employer match for the same reason. Argument number 4, liquidity. This one is underrated. Money in an investment account you can get to. Maybe with a tax hit, sure, but it's there. Money in your home equity? Good luck. You can't exactly cut off the kitchen and trade it for groceries. To access home equity, you've got to sell, refinance, or take out a HELOC, all of which take time, paperwork, and a banker who knows your name. Now let's talk about the concept that secretly controls this entire decision. Opportunity cost. Opportunity cost is basically the financial version of you can't have your cake and eat it too. Except in this case, the cake is $1,000 and you can either eat it now or you can plant it in the ground and hope it grows into a cake tree. I don't love that metaphor, but we're staying with it. Every dollar you use to pay down your mortgage is a dollar that didn't get invested. And every dollar you invest is a dollar that didn't pay down your mortgage. There is no scenario where the same dollar does both jobs. It picks a team. So the real question isn't, is paying off my mortgage good? Of course it's good. Or is investing good? Of course it's good. The real question is, which one is better for me right now given my situation? And that right now part matters more than people realize. The math that's right for you at 28 is probably not the math that's right for you at 58. Your answer should change as your life changes. That's not flip-flopping, that's just being awake. Let me give you the cheat sheet for when paying off the mortgage really is the better move. 1, your mortgage rate is high. We're talking 6% or more. At that point, the gap between your guaranteed savings and the market's potential return narrows dramatically. And remember, the market's return is potential. Your mortgage rate is real. It's already happening every month. 2, you are close to retirement, like within 10 years. Sequence of returns risk is a real thing. The last thing you want is to retire in a 2008-style market and also still have a mortgage payment. Paying it off early de-risks your retirement in a way that's hard to replicate any other way. 3, you want predictable, low fixed expenses. Some people just sleep better knowing the biggest line item in their budget is gone. And honestly, good sleep is criminally underrated as a financial strategy. 4, your retirement accounts are already loaded up. If you're maxing out the 401k, the IRA, doing the backdoor Roth thing, contributing to a brokerage account, and you still have extra money, sure, throw it at the mortgage. At that point, you've won the game. You're just decorating the trophy.
Now the flip side, when does investing clearly win? 1, your mortgage rate is low. Anything between 2.5% and 4%, the math is not even close. You're going to come out ahead by investing over the long haul. 2, you've got decades until retirement. Time is the secret ingredient. If you've got 20 plus years, the market's volatility smooths out and compound interest gets to flex. 3, you're not getting your full employer match. I'll say it again because it bears repeating until I'm blue in the face. Before you even think about extra mortgage payments, the match is an instant 50 to 100% return. Your mortgage cannot compete with that. Nothing can. 4, you're behind on retirement savings. If you're 45 and you've got $12,000 in a retirement account and a fully paid off house, congratulations, you own a lovely home you cannot afford to retire in. Don't fall in love with the wrong asset. Okay, enough theory. Let me give you the actual game plan, the order of operations. If you only remember one part of this video, make it this part. Step 1. Capture your full employer match. If your company matches your 401k contributions, contribute at least enough to get the full match before you do anything else with that extra money. It's part of your compensation package. You've already earned it. You just have to claim it. Skipping the match is essentially telling your employer, no thanks, I don't want that part of my paycheck. Step 2. Kill your high-interest debt.
Credit cards at 22%, personal loans at 15%, pay those off before you do anything else. There is no investment on earth that reliably beats 22%. None. If somebody offers you one, run. Step 3. Build an emergency fund. 3 to 6 months of expenses in a high-yield savings account. This is your I will not panic when life happens fund. Without it, every other financial decision you make is fragile. Step 4. Invest consistently. Max out the tax-advantaged accounts. 401k, Roth IRA, HSA if you have one. Boring, automated, monthly. Set it and don't touch it. Step 5. And only now do we have this conversation. Now you can decide what to do with extra money. Pay down the mortgage, invest more, or, and this is what most people actually do, both.
Speaking of both, let's talk about my personal favorite answer to almost every personal finance question. Why not both? Going back to Dave and Sarah, they've got $1,000 a month. Who said they have to put it all in one bucket? They could put $700 toward retirement investing and $300 toward extra mortgage payments, or 60-40. Or 50-50. This is the hybrid strategy. And honestly, for most normal humans with normal anxieties and normal lives, this is the move. You get the wealth-building power of investing, you get the psychological win of watching your mortgage balance shrink, and you get to sleep at night knowing you're not betting everything on one strategy. Is it mathematically optimal? Almost certainly not. Is it the strategy you'll actually stick with for 25 years without breaking down? Probably yes. And the best strategy is the one you actually follow. A perfect plan you abandon after 8 months is worse than a decent plan you ride for 3 decades. Here's the part where I get real with you for a second. Personal finance is not just math. If it were just math, everybody would be rich, nobody would carry credit card debt, and there would be no need for this channel, which would be devastating for my career, frankly. Money is emotional. It's tied to childhood, security, identity, your relationship, your sense of self-worth. So when you're making this decision, don't just ask, what does the spreadsheet say? Ask, what will I actually feel about this in 5 years? If paying off your mortgage means you'll finally exhale for the first time since 2017, that's worth something real. If investing more aggressively means you'll feel proud and engaged with your money, that's worth something too. Don't let some random guy on YouTube, yes, including me, bully you into a strategy that makes you miserable just because his calculator says it's optimal. Optimal is what works for you, always. So here's where I land. After all the math, all the spreadsheets, all the late-night YouTube rabbit holes. Investing usually wins mathematically when mortgage rates are low and retirement is far away. The numbers are clear. Paying off the mortgage wins emotionally and structurally by lowering your retirement expenses and giving you that bulletproof feeling of true ownership. A balanced, hybrid approach, invest most of it, prepay some of it, gives most people the best of both worlds without the stress of going all in on either side. But here's the thing I want you to walk away with. The real goal isn't to maximize your net worth on a chart. The real goal is to retire with enough income, low enough expenses, peace of mind, and the freedom to do what you actually want with your life. Your mortgage is a tool. Your investments are a tool. Neither one of them is the goal. The goal is the life you're building. Pick the combination of tools that actually gets you there, and gets you there in a way that doesn't make you miserable for the next 25 years. Drop a comment and tell me, are you team pay off the mortgage, team invest everything, or team hybrid? I genuinely love hearing how you all are thinking about this stuff. Subscribe if you haven't yet. There's a new video every week, and we're going to keep breaking down the questions that actually matter for normal people trying to build a real, secure, enjoyable life. Thanks for hanging out, and I'll catch you in the next one.